Dear learners, this is my series of telling you answers for GATE 2022 economics question paper. So here I go with this one covers the questions from 50 number question number 56 to 65. I hope you will enjoy this. So the question number 56 reads like this. A producer manufactures batteries by using techniques 1 and 2. The capacities in ampere hours of 12 randomly selected batteries manufactured by using technique 1 are, so these are the 12 numbers 140, 132 to 142. Moreover, the capacities of 14 randomly selected batteries manufactured by using technique 2 are from 144 to ending up to 135. Suppose that battery capacities manufactured by using techniques 1 and 2 are normally distributed. This is important. It is normally distributed, the technique, with unknown means mu1 and mu2 respectively, and an unknown common variance sigma square. Means we have to calculate a common variance for both the techniques. Consider the null hypothesis. H0 mu1 minus mu11 is equal to gamma ampere hours. Okay, so this gamma is mu1 minus mu2 and that is the H0. Now the question is, for which of the following values of gamma should the null hypothesis H0 be accepted against the alternative hypothesis H1 mu1 minus mu11 is not equal to gamma ampere hours at 10% level of significance. So this question says that mu1 H1 is mu1 minus mu2 is not equal to gamma, means we will have to take two-tailed test. Had it been less than gamma or more than gamma, we would have used one-tailed test. So we start with this G, because why will we use G tables or G values? Because it is normal distribution. So we will not be using T values, because even though it is a small distribution, means the sample size is a small 12 to 14, but still it is from a normal population, so Z value should be used. So it gives the Z values of tables. Pz is less than 1.282 for 90% confidence level, means alpha here is 10 for one tail test, okay, because Z is less than or equal to, and here Z less than or equal to 1.645, which is equal to 0.950. And the question here is asked is here mu1 minus mu11 is not equal to gamma. Here you see it is less than and here it is not equal to. So we should be using this value of Z to be correct. Okay. So now we go down and I had calculated the mean of these 12 random variables. So that was total was 1676 divided by 12 is equal to 143, and alpha is the level of significance, that is 10%, which is same as confidence level of 90%, and mean 2 is 135.8. So clearly mean 2 is less than 143, but we don't have to test that less than, we have to test not equal to. So we will use this value Pz less than 1.645. That is what the correct answer should be. So now joint standard deviation I calculated is 9.9 approximately. And how do you calculate joint standard deviation? This one is under root n1 s1 square plus n2 s2 square divided by n1 plus n2. And I got the value 1.99. So first I used this Z value 1.282 just to check that, okay, how much does it give for if I take one tail test. So this value is 1.282 at 90% confidence level. So I multiplied my standard deviation times 1.282, which comes out to be 12.7. So this gives us the difference of mean at 90% confidence level, or we can say that we fail to reject null hypothesis if this mu1 minus mu2 is less than 12.7. So that gives these figures: 10 is less than 12.7, 7 is less than 12.7, and 4 is also less than 12.7. So these three are definitely the answer if we take one-tailed test. But since this question is not equal to, so we should use two-tailed test, and for that I went down. So GATE has given the answer A, B, C, and let me check what happens if I go for two-tailed test. So when I go for two-tailed test, I multiply gamma is equal to 9.9 times 1.645. This is equal to 16.28. Then D also is less than 16.28. So actually the correct answer should be A, B, C, D. But GATE has made a mistake here. So if some of you wrote this answer A, B, C, D and you got penalized in the last exam, you can ask your question paper to be re-examined under right to information, and I will help you for free. Now next question is, Tom and Jerry both arrive at a petrol pump. Without worrying about price, Tom says, I want 10 liters of petrol. Also, without worrying about price, Jerry says, I want petrol worth rupees 1000. The own price elasticity of demand for Tom and Jerry are. So how do we see the elasticity of demand? When income is fixed or expenditure is fixed, like Jerry, he said, I want petrol worth 1000 rupees. So no matter what price of the petrol we say, if it is 100 rupees a liter, he will buy 10 liters. If it is 90 rupees a liter, he will buy 11 point something liters, so that it completes 1000 rupees. And that way, whatever be the price, his expenditure is fixed. So when expenditure is fixed, the elasticity of demand is always equal to 1. So for Jerry, EJ must be equal to this minus 1, because they are inversely related. So hence answers C, D and E, A are definitely wrong. You get answer G. And what about Tom's? So for Tom's case, it says, I want 10 liters of petrol no matter what the price be. So in that case, the delta Q is 0, because he will always buy 10 liters of petrol. So the elasticity of demand formula is dq dp. Since it is dq dp is 0, the elasticity of demand automatically becomes 0, even if you multiply it by P by Q. So that way the correct answer is B. Now I go to question number 58, and it says, which of the following variables are pushed upward by seigniorage? Okay, so in seigniorage, the government earns revenue by printing more money. So if printing more money is there, then money supply will increase. So that way, he asked the question, which of the following variables are pushed upwards? Then, of course, money supply will be pushed upwards. What about inflation? Well, it may or may not get pushed upward. It will get pushed upward only if there is ceteris paribus, otherwise it won't. But it doesn't mention the assumption ceteris paribus, so you shouldn't assume yourself. Hence, when money supply is increased, the rate of interest falls. And if there are decreasing costs situation, then people will produce more at the lower interest rate of loans, and then inflation will be lower. It can be less than negative. Or when Keynes had said that there is output gap or recession, or there is then also this inflation doesn't go up when prices, when money supply is increased, and also when there is technological innovation, more output will be produced with money supply and inflation will go down. So inflation may not get pushed upward, hence correct answer. What about tax rate? Well, there is nothing like taxes here, so it is not the option. And interest rate will go down, as I said. So the correct answer should be A. That is the indisputable answer. Money supply will definitely increase, but inflation may increase, may not increase. We are not sure about it. But GATE has given answer A and B. So here also GATE is wrong, because it is possible that if money supply increases by 10%, output may increase by more than 10% as interest rate has fallen, when there are economies of scale or when there is technological innovation, the inflation will be negative. So only A is the correct answer. Now I go to next question, and this is question number 59. So it says, suppose Raju enters the job market at age 25 and earns annual income of rupees 6,000. He retires at age 65 and his life expectancy is 75 years. Means he has still 50 years to live. He doesn't own any assets. Assume that Raju consumes annual income uniformly over his lifetime. Here it is uniformly. The word uniformly is here. He consumes uniformly. So it means his average propensity to consume is constant. What will be his average propensity to consume during employment years? So average propensity to consume formula is total time to earn divided by total time to consume. So since he is earning for 65 years, so total time to earn is 65 minus 25, which is equal to 40, divided by his total time to consume, that is 75 minus 25, 50. So APC is 0.8. Hence answer B is correct. Question number 60. So this question is, a monopolist faces the following inverse demand function. P is equal to 40 minus Q, where P denotes price and Q denotes quantity. The monopolist has zero fixed cost and a marginal cost of 5 per unit of output produced. The monopolist aims to maximize profit. Suppose the government imposes a tax of 5 per unit of output of the monopolist. As a result, the price charged by the profit maximizing monopolist to consume increases by. So we go by this mathematical as well as graphically. So mathematically P is equal to 40 minus Q. Total revenue is PQ, which is 40Q minus Q square. And we calculate marginal revenue, because for profit maximizing, marginal revenue must equal marginal cost. So MR is equal to derivative of PQ, which is 40 minus 2Q. So MC is equal to 5 given. Now equilibrium is gives marginal cost is equal to marginal revenue. So 40 minus 2Q is equal to 5, because that is what marginal cost is. So this gives us on the calculation Q is equal to 17.5, which is equal to 40 minus 17.5, and which is equal to 22.5. So P is equal to 22.5 and Q is equal to 17.5. Now after tax, marginal cost becomes 10. So we calculate the same thing. Marginal revenue is equal to marginal cost. Marginal revenue doesn't change. So we calculate 40 minus 2Q is equal to 10, or that gives 2Q is equal to 30, or Q is equal to 15, and P is equal to 25. So change in P is 25 minus 22.5, which is equal to 2.5. So if you don't know how to solve mathematically, you can still solve it graphically. And graphically, here is the total price. P can be 40 when Q is equal to 0, and when P is equal to 0, Q is equal to 40. So this blue line is the demand curve, and obviously marginal cost curve has the twice slope. So I took it, and from this passing through 20, this is the marginal cost is the yellow line, and the equilibrium point gives here marginal cost is equal to 5. So this is the point, and this gives you 17.5 Q, and when Q is 17.5, you can easily figure out P is equal to 22.5 because 40 minus Q. So P is 22.5, and when marginal cost is 10, means this orange line, so marginal cost is equal to 10. The equilibrium point gives here intersection, and it is the 15 is the new output, and new price is 25. So that way you can calculate this graphically also. So answer is B. Now I go to next question, which is question number 61. It says, in the flexible exchange rate environment with perfect capital mobility, a fiscal stimulus will be linked to which of the following statements? So this is really a very difficult question actually, though it looks very small, but you need to know Mundell-Fleming model. So it says, first of all, there is perfect capital mobility, means foreigners are free to invest in my country, and I, as an Indian, can invest anywhere in the world. So there is a perfect capital mobility. So whenever there is perfect capital mobility, interest rate remains the same. So that way interest rate is equal to world interest rate. So I is equal to I star. Now, the fiscal policy increases the domestic output. This doesn't happen because when there is fiscal policy, means any increase in government expenditure or decrease in government expenditure. So let us study that there is increase in government expenditure. So say initial equilibrium is this ISLM. IS curve is the saving investment, and LM is the money supply. So when the government spends more, then the money supply is fixed, so interest rate goes up. When interest rate goes up, this IS curve moves up to the yellow line. Now this shows that, well, the output should go up from here, say from this part to this part, output should go up. Okay, but it doesn't go. So this one was the equilibrium. So I am just writing here initial equilibrium, and that is E. Well, I shouldn't have written here, I should have written it a bit down. So this is the E part, okay, initial equilibrium, and it moved to the right, but can it stay? The answer is no, because the money supply from foreigners will come as they are seeing this higher interest rate in the domestic economy, and there will be swift flow of capital, and that will reduce the interest rate. So when interest rate is reduced, what happens to exchange rate? There is more demand of our domestic currency because foreigners are willing to invest in our country to take benefit of higher interest rate. So in that case, the rupee becomes stronger, or domestic currency becomes stronger, which adversely affects exports. So exports will be reduced. So that way, this yellow line, this IS plus DG delta G curve will shift back to the original line because everything happens very fast in perfect capital mobility, and the equilibrium will be restored at this point through NX. So if this delta G is plus, then minus NX means here I will write this part will be X minus M, that will be lower, that will become be lower equal to delta G, and that way this initial equilibrium will be reached back. So the government fiscal policy will not be able to influence domestic output. Now fiscal also B is automatically correct, and fiscal policy leads domestic exports to fall. Yes, that is what already I said, that since rupee has become stronger, exports will fall, and fiscal policy appreciates the domestic currency, that I already said, because interest rates went up. So when interest rates went up, foreigners rushed to invest in Indian rupee, and that way the demand for Indian rupee went up and exchange rate went up. So that way B, C, D would be the correct answers. That is what Gate has given. Now we should go to question number 62, and this question is: consider a lottery with two possible outcomes, rupee 1 with probability rupees 100 with probability 0.6 and rupees 50 with probability 0.4. The maximum amount that a risk neutral person, here it is, the risk neutral person means he will pay the fair price. Had he been risk averse person, he would have paid less than mathematical expectation, and had he been risk lover, he would have paid more than mathematical expectation price. So we calculate mathematical expectation, which is equal to 0.6 times 100 plus 0.4 times 50, which is equal to 80. So risk neutral person would be willing to pay rupees 80 for this lottery. Now question number 63. This one is the Mr. Sharma's consumption preference for tea, denoted by X, and sugar, denoted by Y, is given by the utility function uxy is equal to min x comma 2y. So the price per unit of tea is 10 and the price per unit of sugar is 10. Mr. Sharma's total income is 900. The optimal quantity of tea purchased by Mr. Sharma equals. So how do we calculate this? So this is a Leontief function which has strict complementarity. So here each good is equal, x is equal to 2y always by default, because it is a Leontief paradox, Leontief production function. So here x is equal to 2y, and this must equal to total of the income, budget line. So px times x plus py times y is equal to I, or 10 times 2y plus 10 times y, because I substituted x is equal to 2y. That gives me 30y is equal to 900, or y is equal to 30, and since x is equal to 2y, so x is equal to 60. So the correct answer is the optimum quantity of tea purchased is 60. Next question is number 64, and it reads: suppose alpha is a real number between 0 and 1. Rohit is choosing x and y to maximize the following utility function. So this is the utility function uxy, x square plus 2xy plus y square plus 4a square plus 8a plus 10. So a is a real number between 0, means it is more than 0 and probably less than 1, or it can be from 0 to 1. Now, so to maximize utility function with respect to x and y, we take the first order condition. So first order condition says du dx, that is equal to 0. So this gives 2x plus 2y is equal to 0. And du dy is equal to 0. That also gives 2x plus 2y is equal to 0. Now, that's why we need more constraint, because it can have infinite number of solutions, since x can take any value, and x is equal to minus y, or y is equal to minus x. That's what, or both x and y can be 0. So these two values, well, these not two means many values, satisfy the equation. So the constant is 2x plus y is equal to 10. So I use this constant. So 2x, and since y is equal to minus x is equal to 10, or that gives x is equal to 10. So when x is equal to 10, then what should be y? Y is also greater than 0, so y should also be 10. Otherwise, if y is 0, then this function won't be maximized. Okay, it will be only x square, which will be 100, and some values of a. So 100 plus 110 plus this 4a square plus 8a. But when y is also 10, then it will become much more, 200, and here 410 plus 4a square plus 8a, that will be the value. So since y has to be greater than or equal to 0 and y can be 10, so that would help maximize our utility function. So the optimal value of y chosen by Rohit is 10. So I should write here 10. That is the correct answer. And now I go for the next and last question. It says, a competitive market for dry cleaning, the inverse demand function is given by P is equal to 100 minus Q, where P denotes price, Q denotes quantity. The private marginal cost of production for all the dry cleaning firms together is given by MC is equal to 20 plus 2Q. The market pollution generated by dry cleaning process of all firms creates external damage given by the marginal external cost equal to 2Q. So the socially efficient output is where, since it is competitive market, so price will be equal to marginal cost. And we need to calculate, it is socially efficient, so we need to calculate social marginal cost, which is equal to private marginal cost plus marginal external cost. So that gives 20 plus 2Q is the private, and 2Q is MEC plus 20. So that gives us 20 plus 4Q. That is our social marginal cost. And this must equal our price. So price is 100 minus Q, and that is equal to marginal cost. So 20 plus 4Q, and that gives us 5Q is equal to 80. And so Q is equal to 16. So that's the end of this section. I hope you found it interesting and you found my explanation clear and understandable. Thank you very much. Please don't forget to like and subscribe my channel. Thank you. Bye bye.